Hello, guys. Welcome back to the third episode of the full Smart Money Concepts course. In this video, we will discuss the most important concept in the whole Smart Money concept approach. Or maybe it is one of the keystone topics when it comes to trading as a whole. It is none other than liquidity. We retail traders like to get things done the easier way. Therefore, we usually focus on indicator signals for taking trades. We are least bothered about why the price moved in a particular manner that triggered the indicator to give a buy or a sell signal. Almost all indicators are derived from fundamental elements of the market, which are price and volume. Further, price and volumes are a result of the post-processing of basic market data. So the point that I want to elaborate is that indicators can to some extent do a good job in generating winning trades. But most indicators fail to work in all market conditions, and the signal provided by a single indicator cannot be trusted completely. And to top it all off, almost all indicators are lagging in nature and they give a trade signal after the move has already started, which result in more risk and thereby lowers your reward to risk ratio. So one way to stay on top of the market is to play the game like the market makers, big institutions or banks, or simply the smart money who feeds on the retailer orders to make a living. The big price moves or momentum moves that you witness in the market are a result of the smart money trapping the uninformed traders, or should I say the ill-informed traders, because retail education, as we all know, is based on patterns like candlestick patterns, chart patterns, trend lines, support resistance zones, etc. And eventually they hope on to taking trades on the signals given by conventional indicators or price patterns. I'm not saying that these patterns and indicators don't work at all, but there are high chances that most of these can be engineered by the big players. These big institutions or smart money are always trying to trap us and take our stop losses. So when new traders come fresh onto the markets, they can easily be manipulated and money can be taken away from them because they are easy prey for the big boys. The retail traders' lack of knowledge as to where the majority of market orders are accumulated makes them vulnerable to these institutional traps. This is the major reason why most of the retailers lose money. They remain as prey to these banks and institutions, or in other words, they are liquidity for the big players. In essence, this is a cat and mouse game. In order for one person to win, someone else needs to take a loss. So the question is, what do you want to be, the cat or the mouse? Now there is a popular saying in the market that if you don't know where the liquidity is, then you are the liquidity. So in this episode and the upcoming episode, we will talk extensively about this prime concept of liquidity to stay ahead of the majority of retailers and also to stay clear of most of the smart money traps. I can guarantee you that once you understand the entire concept of liquidity, you will think more clearly as to how the market functions, and it will also open up new trading possibilities for you. So let's get started right away. For some of you, there might still be this doubt as to what exactly is meant by liquidity. So in simple terms, a market with high liquidity is one where there is a large number of buyers and sellers willing to trade in that particular asset. This means that there is a high availability of buy and sell orders, allowing transactions to be executed quickly and with minimal impact on prices. So think of liquidity as an area where there is stop losses and pending orders waiting to be filled. We can find liquidity in areas or zones where many people place their stop losses, be it buy or sell stops. Usually, retail traders are impulsive and they tend to buy at highs when greed kicks in and they sell at lows when panic kicks in. But at all times, when there is a buyer in the market, there is always a seller and vice versa. And that's how the markets work. Now, the smart money, aka institutions, use this retailer liquidity, that is the orders of the retail traders against them. For example, the institution buys at lows when retail traders sell after a breakout of that low. Similarly, they sell at highs when the retail traders buy after the breakout of a high. So in essence, we are all liquidity in the market. However, that does not mean every single order which is being placed in the market must be targeted and taken out by these big players, as some areas are simply not liquid enough for it to be worth the grab for these institutions. So in short, Liquidity is like fuel, or it acts as a driver to move the market in a specific price zone. Smart money will try to manipulate the price in order to break through these obvious zones and seize or absorb the liquidity. To sum it all up, every market has retail traders and institutions. The retail mindset is almost same across all the markets, and liquidity in smart money concepts enable us to understand where these retail traders are being manipulated and where the smart money is entering or exiting. Now, another question can pop up in your mind. Where to find these liquidity zones or order clusters? Now, there are two types of liquidity based on direction. They are buy-side liquidity and sell-side liquidity. The buy-side liquidity represents a level on the chart where the short sellers will have their stop loss positioned. So essentially, these stop loss orders set by the short sellers who sold from the resistance or the swing highs are essentially buy orders. And the buy-side liquidity will also include buy limit orders set by all those buyers who were waiting for a breakout above the resistance or the swing high. When it comes to sell-side liquidity, it is just the opposite. It represents a level on the chart where long bias traders will place their stop losses. So essentially, this cluster of orders will include stop loss orders set by buyers who went long from the support level or swing low level, which in turn is a sell order. And sell-side liquidity will also include sell limit orders which were set by those sellers who were anticipating a breakdown below the support or swing low. In both these cases, these levels are often found at or near extremes as the tops and bottoms of the ranges, meaning that these points are found at the highs and lows of ranges. This is because at these points, many people are waiting for the zone to act as a support or resistance, or for the price to break the zone to continue in its direction. So you can always use higher time frames like daily, weekly, and monthly time frames to identify these zones. Now, if you want to understand where to find liquidity even simply, then understand that whenever there is a trend line, support or resistance level, double top or double bottom patterns, channel patterns, rectangular ranges, swing levels, etc., there are a lot of retail stop losses and pending orders available, meaning that there is enough liquidity to be taken. Therefore, these are popular areas where retail traders tend to execute their trades. So there will be a lot of stop losses, making it a nice level of liquidity for the big players to target. But before all that, let us understand why liquidity is important on a price chart. So if you think about it, liquidity is extremely important because it is the direction in which the price moves. The price will always move towards these points to attract liquidity to the market. Without liquidity, financial markets cannot function. Let me explain this so that you will have a better idea. See, big players in the markets aim for the best prices, but usually they face challenges finding sufficient counter orders to fill their large orders. For example, if an institution is looking for long positions, they will place buy orders at limit prices. But for the order to get executed, there needs to be enough sell orders, right? Now think about what happens if they enter the market at low liquidity areas where there are only fewer orders available to counter the institutional orders. This will create much more volatile markets, which will negatively impact the average price of the big players, which is actually a risk they are not willing to take. Now, on the contrary, entering at a high liquidity area where there are a lot of counter orders available will result in less volatile markets, ensuring a better average price for the institutional position. And these high liquidity zones are where most of the retail orders are placed. Smart money players understand the nature of this concept, and they will commonly accumulate or distribute their large positions near levels where many stop losses resides. This concept of absorbing retail orders by taking advantage of all available liquidity at multiple price levels is called as liquidity grab or liquidity sweep, and it comes from the need for big players to enter the market in these zones to take their large positions, and it ensures that their orders are filled at the best possible prices by breaking up their order into smaller suborders and then spreading them across multiple price levels. So institutional traders and high-frequency trading firms commonly use liquidity sweeps for efficient and quick execution of large trade volumes. And the sheer amount of stop loss orders available at these key levels allows a large player to fully realize their positions. And once this level where many stop losses have been placed has been traded through, it is often seen that the price will reverse its direction and head in the opposite direction, seeking liquidity at the opposite extreme. Now, think about the result when a large number of stop losses are triggered. If price experience higher volatility or more orders hitting the market, such volatility in price generates opportunities for participants to either enter a trade in a favorable environment or protect their positions. The fact that too many orders were triggered all at once result in sharp price moves in the market. So without ample liquidity to play with, we will never see such big directional moves in the market. In fact, how will a car be able to move without fuel? Similarly, it is liquidity zones and liquidity sweeps that helps to run the markets smoothly. Now, I hope this clears things up. Next up, let's briefly touch upon the different types of liquidity areas within the market structure. Based on this, liquidity can be classified into external liquidity and internal liquidity. Now, as the name suggests, liquidity associated with major market structure is referred to as the external liquidity. It is also known as major liquidity, and the liquidity associated with minor or internal structures in the market is named as internal liquidity or minor liquidity. In this video, however, I will only talk about external liquidity and how to spot external liquidity. So to understand what external liquidity is, we need to have a fair understanding about market structure, predominantly the major market structure. I have already made a video on market structures and how to properly mark the swing points, namely the swing highs and lows, and also to identify and mark break of structure, change of character, etc. So if you haven't watched the video, I urge you to pause this video right away and watch the first episode of this course right now to get a better understanding as to how major liquidity functions. To briefly summarize things, a bullish market structure will have higher swing highs and higher swing lows. A higher high is confirmed only after a valid pullback, and a higher swing low is confirmed only after a valid break of structure. And a change of character happens when the price break and close below the previous swing high or higher high, thereby shifting the market sentiment towards bearishness. Now, when it comes to a bearish market structure, it comprises of lower swing highs and lower swing lows. A lower high is only confirmed after a break of structure, and a lower low is confirmed only after a valid pullback. And a bullish change of character happens when price manages to break and close above the previous swing high or lower high, indicating a shift in the sentiment from bearish to bullish. Now, these are basically the things that you need to keep in mind while learning the major market structures. Now, let me ask you, which are the most important points when it comes to major structure? Quite clearly, these points are higher highs and lows and lower highs and lower lows, or simply these are the major swing highs and major swing lows. Now let me ask you another question. Why do you think the market does a break of structure or a change of character and then does a pullback? What do you think about this particular behavior of the market? Okay, let me explain. Let's take the case of a bullish break of structure and a bearish change of character. Now, what are they? These are basically simple breakouts, right? But if you think about it on a much deeper level, what exactly is taking place here? As we are aware, a bullish break of structure happens when price breaks and closes above the previous swing high or higher high. So one must focus on the swing high level. The swing high is considered as a strong resistance level or a supply zone. There can be at least two types of participants waiting in this area. The former would be sellers, who are obviously trying to take short trades from the swing high or the so-called potential resistance level. And where will they put their stop losses? Quite obviously, they will set their stop losses, which is actually a buyback order above the swing high. Now, the second group involves buyers who are anticipating a breakout of prices above the swing high level because the current market trend is bullish. So, what will these buyers do? They will look to buy on the breakout and they will place their stop loss, which is a sell order, just somewhere below the swing high level. So as you can see, there is a large cluster of orders available above and below the swing high level. So this is a highly liquid area. So now what will happen? Depending on which side has majority of orders, the market will move in that direction to absorb or sweep the liquidity. In this case, a breakout above the swing high has happened, meaning that the concentration of buy order was much more than the amount of sell orders available below this level. This is why the market moved higher, absorbing all the seller stop losses and buy limit orders. A similar scenario takes place in case of a bearish change of character. Which is our level of interest in this case? Yes, you are right. It is the higher low or simply the swing low level. Now, applying the same logic here also, there are at least two interested players here. The former are buyers, since the swing low has the potential to act as a support or demand level, and since the trend is also bullish, the buyers will look to take long trades from this level. And where do you think they will set their stop losses? Quite obviously, they will set their stop losses, which mind you is actually a sell order, somewhere below the swing low level. Now the second group comprises of those sellers who are looking for a breakout below this swing low level. Now if you look carefully, you can see a proper trend line, and thus they will bet on the breakdown below the trend line as the price has tested the trend line multiple times. So they will look to sell on the breakdown, and they will obviously place their stop loss somewhere above the swing low or even above the recent swing high. So quite clearly, there are a large number of orders available above and below the swing low level. So this is a highly liquid area. Now what will happen? Depending on which side has majority of orders, the market will move in that particular direction to absorb or sweep the liquidity. In this case, a breakdown below the swing low has happened, meaning that the concentration of sell orders was much more than the amount of buy orders available above this level. This is why the market moved lower, absorbing all the buy stop losses and sell limit orders. I hope you have understood. In a similar manner, you can understand what happens during a bearish break of structure or a bullish change of character. Now, I hope things are making sense. But still, a question remains. Why don't the market just keep going in the direction of the breakout? Why do price stop and return back? Or why do prices form pullbacks? So, if you have observed closely, once the price does a break of structure or a change of character, it does not move up or move down indefinitely. If we take the case of a bullish break of structure above this previous swing high, we will come to know that the price will move up only to that extent where the orders are available. Or in other words, as long as liquidity is available above the swing high, the market will move higher. This is because the smart money is absorbing all the buy-side liquidity so as to sell high. And once it has absorbed all the orders above this swing high, where do you think the market will go? Now, one thing that you must keep in mind is that the market moves from one area of liquidity to the other. So based on this idea, where will the market find liquidity once it has swept all the orders above the previous swing high or once the buy-side liquidity is completely taken out? Think about it. There is no liquidity available anywhere higher. So no point in going higher. So where will the market go now? This is where we have to think about why the market does pullbacks after a break of structure or even a change of character. I can just tell you that it is the inherent nature of the market to move as waves, forming impulse and corrective moves, and just stop the discussion. But understanding the reason behind these pullbacks are very important. Let me remind you that the market needs fuel to move higher or lower. This fuel is none other than liquidity in the form of retailer buy or sell orders, as you may already know. Now, liquidity is the reason why market forms impulses and corrections. In this case, after sweeping out the buy limit orders and buy stops, which is actually the buy side liquidity, the market pullbacks lower. And what is the purpose of this pullback? The pullback is the way in which the market is looking for a sell side liquidity. And where can we find these clusters of sell limit orders and sell stops? This is why you need to have a proper understanding of how the market structure forms and functions. In this particular case, after a bullish break of structure, the market can pull back to a few possible levels where it could find liquidity. And only after it has tapped the liquidity from these levels, the market will continue to move higher. These levels could either be internal or minor swings formed within a wave, or it could be the major swing low also. Below these minor swings and major swing low levels, there will be a lot of players looking for a trade opportunity. Usually, the previous major swing low level is considered to be a strong demand zone or a support level. So most buyers would be interested to take a long trade from this level, and they will obviously set their stop losses below this major swing low level. So there will be a lot of sell orders available below this level, and so the market could tap into this liquidity pool to sweep all the retailer stop losses to buy at lower prices and then move up higher. Now the price won't always move all the way down to this major swing low. If you look at the chart, on most occasions, the price will pull back only by 40% or 50% before resuming the main trend. Now what do you think is the main reason for this? Now I want you to understand that when price pulls back, it has got a few liquidity options to tap into. I have not discussed some of these terms yet, but bear with me on this. So the first option is to tap into an inducement level, which you can consider as a previous minor swing below which you can find liquidity, as traders will look to buy from this level assuming a double top formation, while some sellers will place sell limit orders anticipating a breakdown of prices. Now both this action will result in a pool of sell side liquidity that the smart money can tap into. The next available options are order blocks or point of interest. And just for the sake of understanding, assume POI as areas where large number of buy or sell orders are placed by institutions for the sake of buying low and selling high, and we can expect the market to reverse from these zones. So the market can tap into either of the two order blocks. The first is a decisional POI, which is usually formed after an inducement, and there is a 50% chance that the market will tap into this liquidity area and reverse higher. And the other order block is formed near the major swing low level, and it is usually called the extreme POI. So the other 50% chance is that this extreme POI will be tapped to absorb orders. The price will go deeper into these levels to absorb all the available orders. Usually, VSMC traders will take buy and sell trades from any of these three mentioned liquidity levels. We will talk about the concepts of inducements, order blocks, POI, etc. in our upcoming episodes. But I hope you have understood the overall concept behind external liquidity. Now let us briefly take a look at where to spot these external liquidity levels, or under which circumstances can we observe these levels. So as you may have already guessed, the major swing highs and major swing lows, especially on higher time frames, are high probability areas where we can find major liquidity. You can understand this using a simple example. You can mark the structure on a 1 minute time frame, which is a lower time frame, and then mark the structure on a 1 hour higher time frame. In which time frame do you think there will be more orders present near the swing highs and lows? Without much thinking, we can say that the higher time frame swing levels will have more liquidity in comparison to the 1 minute swing levels, meaning that there will be more meaningful price reactions on higher time frame structures. Another location to find major liquidity is where equal highs or equal lows are formed near the previous swing highs or swing lows respectively on a higher time frame. There are good chances of finding sell side liquidity below these equal lows and buy side liquidity above these equal highs. The same logic applies to double tops and double bottoms, which are formed near these major swing points. Yet another location where you can find major liquidity is below an uptrend line drawn connecting the major swing lows, or above a downtrend line drawn connecting major swing lows. These trend lines are quite lucrative places because you can find both buy and sell side liquidity, because one party is looking to benefit from a breakout of the trend line while the other party is looking to gain from a reversal from the trend line. Obviously, the smart money will target these trend lines, and most often you can see fake outs from these trend lines, which are none other than the big players sweeping the liquidity to get better entry prices. Now, the other important locations where you can spot major liquidity includes the previous monthly highs and lows, previous yearly highs and lows, previous weekly highs and lows, and even the previous daily highs and lows. These are all levels that a large number of participants are keenly watching to take a trade, and therefore there will be a large number of orders getting accumulated here. These are all prospective locations with very high liquidity. Since we don't have the kind of information that the big players possesses, we cannot determine the strength of a liquidity area and the exact location of liquidity at all times. Therefore, we can only predict where the liquidity can be discovered. But you must understand that The larger the time frame, the greater the liquidity. However, the more we go down onto smaller time frames, the more weak the liquidity will be. So these are all the things that you need to know about liquidity, especially external liquidity. In the next episode, we will turn our attention to internal liquidity. Till then, learn and revise this topic a few times and then try to find areas of external liquidity after properly marking the major market structure and see how the market moves from one area of liquidity to other. So if this video gave you some valuable insights, please do spare a minute to like and share this video. Also make sure to subscribe to the channel if you are new, and do not forget to enable the bell icon so that you will be notified when the next episode comes out. I will see you guys in the next video. Till then, bye.